Silvia Bizzoni, good morning. I am Silvia Bizzoni. This is the Black Box Morning Report. It is 8 a.m. in London, 3 a.m. in New York. We are tracking a complex global landscape as the European markets open their doors. The fundamental narrative today is driven by a new regime at the Federal Reserve under Kevin Warsh, shifting inflationary pressures, and a geopolitical energy matrix that is becoming increasingly volatile. US markets are currently closed for the overnight session, but the futures are providing a clear, if sobering, roadmap of where institutional sentiment is gravitating. The S&P 500 futures are currently trading at 6,826.50, down 0.29%. The Nasdaq 100 futures are feeling more pressure, down 0.35% at 25,017.75. We are seeing a recalibration of risk as the market digests a slowing US inflation print and prepares for the critical February jobs report due this Friday. Let's get into the deep dive. As the opening bell rings across the European exchanges, the atmosphere is one of calculated caution. We are monitoring the Euro Stoxx 50 and the DAX closely as they react to a diverging transatlantic monetary policy. The primary focus here is the dialogue between European Commission President Ursula von der Leyen and IEA Executive Director Fatih Birol. They are meeting to address what the Financial Times describes as spiraling energy prices. This is not just a regional concern, it is a structural threat to European industrial competitiveness. The European Central Bank is in a difficult position. Unlike the US, where Kevin Warsh is expected to maintain a rigorous, hawkish focus on price stability and dollar strength, the ECB is dealing with a stagnant growth environment. François Villeroy de Galhau has explicitly stated there is no immediate reason for the ECB to raise rates further. This creates a policy gap. If the Fed remains firm under Warsh while the ECB pauses or pivots, the euro faces significant downward pressure. We are also seeing the impact of the US-Israel-Iran conflict on European energy security. The recent US decision to allow India to continue purchasing Russian oil, despite the broader sanctions regime, underscores the desperation of the global energy market to maintain supply fluidity. For Europe, this means energy costs remain the primary driver of producer price inflation. Investors are watching the utilities and manufacturing sectors in Germany particularly closely this morning. The safe haven narrative is also gaining traction, as institutional players seek refuge from the volatility seen in the US futures and the escalating tensions in the Middle East. Moving to the US outlook, Wall Street closed yesterday with a sense of wait and see, but the futures market this morning is signaling a retreat. At 6,826.50 for the E-mini S&P 500, we are seeing a tactical pullback. The Nasdaq 0.35% decline suggests that the AI exuberance is meeting the reality of higher for longer discount rates. The appointment of Kevin Warsh as Federal Reserve Chairman has fundamentally altered the Fed put expectation. Warsh is known for his skepticism of open-ended quantitative easing and his preference for a more rule-based monetary policy. The market is currently repricing the terminal rate. The 2.4% inflation print for January, while technically a slowdown, is still above the 2% target. In the Warsh era, close enough is likely not going to be sufficient for a rate cut. The VIX is trading at 23.35, down 1.68%. While the decrease in the volatility index might seem counterintuitive given the futures drop, it indicates that the current move is an orderly repricing rather than a panic-driven sell-off. We are seeing institutional hedging through options, but the fear factor is currently contained within a known range. Nvidia remains the outlier, trading up 0.68% at 183.34 in the pre-market. Tesla is essentially flat at 405.55, and Apple is showing minor gains of 0.02%. The concentration of gains in a handful of mega-cap tech stocks is a structural risk we have highlighted before. If the Nasdaq futures continue to slide, these pillars will be tested. In Asia, the picture was mixed but predominantly defensive. The KOSPI in South Korea managed a marginal gain of 0.02%, closing at 5,584.87, despite earlier reports suggesting a deeper fall of 1.20% during the session. This intraday recovery suggests that local institutional support stepped in at the 5,500 level. The South Korean economy is the canary in the coal mine for global trade. The volatility in the KOSPI reflects the ongoing tension between technological demand, Samsung and SK Hynix, and the reality of a slowing global consumer. FX Street noted the 1.2% dip earlier in the session, which was largely attributed to fears over the US-China trade relationship and the potential for a more protectionist US stance under the current administration. Furthermore, we must look at the broader Asian context. The Japanese Nikkei and the Chinese CSI 300 are struggling to find a clear direction as they await the Fed's March decision. The shift in U.S. leadership at the Fed is particularly impactful for Asian central banks, which often have to mirror U.S. moves to protect their currencies from capital flight. With Warsh at the helm, the expectation is for a stronger dollar, which complicates the inflation-fighting efforts of the Bank of Japan and the People's Bank of China. The bond market is where the real story is being written. The Warsh Fed represents a return to classical monetary principles. The Treasury yields are reflecting a market that is no longer certain of a March rate cut. When inflation sits at 2.4% and the new chairman has a history of prioritizing the dollar's integrity, the yield curve must adjust. We are seeing a flattening of the curve. Short-term yields remain elevated as the market prices in a higher-for-longer stance, while long-term yields are being suppressed by concerns over long-term economic growth under a more restrictive monetary regime. The 10-year Treasury is the benchmark to watch. If it breaks significantly above current levels, the equity risk premium becomes increasingly unattractive. The Better Markets report, noting that senior Fed and SEC staff are joining their ranks, suggests a tightening of the regulatory environment as well. This confluence of tighter money and tighter regulation is a double-edged sword. It creates a more stable financial system in the long run but restricts the liquidity that has fueled the bull market of the last decade. Investors are moving away from speculative assets and into high-quality corporate bonds and short-term treasuries, seeking yield without the equity market volatility. The focus now shifts to the Fed's March decision. Forbes has highlighted several key factors to watch, but the primary variable is Kevin Warsh. His approach to the balance sheet will be just as important as his approach to the Fed funds rate. Quantitative tightening is likely to remain on autopilot, or perhaps even accelerate, as Warsh seeks to drain the excess liquidity that he has previously criticized. Across the Atlantic, Christine Lagarde is facing a different set of pressures. Bloomberg's "Will she or won't she?" analysis regarding her next move underscores the uncertainty. If the Fed remains hawkish and the ECB remains dovish, the EUR-USD pair could head toward parity. Villeroy's comments suggest the ECB is more concerned about a recession than they are about the last mile of inflation. This divergence in policy is a major theme for 2026. We are also seeing a shift in the SEC's posture. The movement of staff between the Fed, the SEC, and advocacy groups like Better Markets indicates a coordinated effort to address market exuberance. This is a sophisticated regulatory pincer movement designed to prevent a bubble in the AI and crypto sectors from becoming a systemic risk. In the commodities space, we are seeing a sharp divergence. WTI crude futures are up 1.86%, trading at 81.54. This is a direct reflection of the geopolitical premium. The US-Israel-Iran conflict is no longer a peripheral issue, it is a central market driver. The BBC's report that the US is allowing India to purchase Russian oil is a pragmatic admission that the global economy cannot survive a total removal of Russian barrels from the market while Middle Eastern supply is at risk. Gold, however, is providing a counterintuitive signal. It is down 0.58%, trading at $5,107.20. Usually, in times of war and inflation, gold is the primary beneficiary. Investopedia notes that experts are puzzled by this price action. The explanation lies in the Warsh effect. A stronger dollar and higher real yields make non-yielding assets like gold less attractive. If the market believes Kevin Warsh will successfully defend the dollar and crush inflation, the need for a gold hedge diminishes. We must also monitor silver and other industrial metals. The headlines regarding avoiding taxes on silver investments suggest a retail interest in physical assets, but the institutional flow is currently dominated by energy. The von der Leyen-Birol meeting is the key event for the energy sector today. If they announce a structural cap on prices or a new joint buying mechanism, we could see some of the heat come out of the Brent and WTI contracts. In the equity sectors, the Magnificent Seven narrative is fracturing. Nvidia continues its dominance, up 0.68%. This is driven by the insatiable demand for H100 and black box era chips. However, the rest of the tech sector is struggling. Tesla's 0.02% gain is effectively a stagnation. Elon Musk's freewheeling tweets, as Bloomberg puts it, have once again landed him in legal jeopardy. For investors, this adds a layer of key man risk that is difficult to quantify. When the CEO's social media activity leads to SEC scrutiny, the stock's valuation, which is already based on future promises rather than current multiples, becomes vulnerable. Apple's 0.02% move shows a company in a defensive posture. They are no longer the growth engine of the S&P 500, they are the safe haven of the tech world. MicroStrategy is down slightly at 139.81, minus 0.06%, following the massive surge we saw as Bitcoin approached $73,000. Michael Saylor's math, asserting there isn't enough Bitcoin for everyone, is being tested by market liquidity. MicroStrategy is now less a software company and more a leveraged Bitcoin ETF. This makes it a high beta play on the digital gold narrative, but it also means it is highly sensitive to the dollar's strength under the wash Fed. Finally, we look at the banking sector. With 16 new bank account promotions offering up to $3,000, it is clear that banks are fighting for deposits. This is a classic sign of a tightening liquidity environment. Banks need capital, and they are willing to pay for it. The US dollar is the king of the board this morning. The DXY index is benefiting from the wash premium. As we have discussed, the expectation of a more disciplined monetary policy is driving capital back into the dollar. The euro is under pressure from the ECB's dovish tilt and the energy crisis. The British pound is also facing headwinds as the UK deals with its own stagflationary pressures. The yen remains the wildcard. If the Bank of Japan is forced to hike rates to defend the yen against a rampant US dollar, we could see a massive unwinding of the carry trade. This would have global repercussions, particularly for the US Treasury market. We are also watching the Indian rupee. Given the BBC report on the oil deal, India's currency is in a unique position. They are benefiting from discounted Russian energy, which helps their current account deficit, but they are also exposed to the general emerging market sell-off triggered by a strong dollar. Bitcoin is currently trading at $70,516.80, down 0.39%. This follows a period of intense bullishness where the asset neared the $73,000 mark. The Saylor math, the idea of absolute scarcity, is the primary fundamental driver. However, the short-term price action is being dictated by the macro environment. Bitcoin has increasingly traded like a high beta tech stock. When the Nasdaq futures fall, Bitcoin usually follows. The 0.39% dip this morning is a direct reflection of the Nasdaq's 0.35% decline. The Roundtable.io report on MicroStrategy and Robinhood surging as Bitcoin nears $73,000 shows that retail interest is returning. But we must be careful. The institutional side of the market, the spot ETFs, are the ones holding the floor. If Kevin Warsh signals a move that drastically increases the cost of capital, the speculative fringe of the crypto market will be the first to be liquidated. Bitcoin's status as a safe haven is still a matter of debate. In this environment, it is behaving more as a liquidity sponge than a hedge against systemic failure. The roadmap for the rest of the week is dominated by one event, the February jobs report this Friday. CNBC and other outlets are already framing this as the most important data point of the quarter. Why? Because the Fed's dual mandate is now in direct conflict. If the jobs numbers come in too strong, it gives Warsh more room to stay hawkish, which the market will likely view as a negative for equities. If the numbers come in too weak, it signals a recession, which is also negative for equities. The Goldilocks scenario, a slight cooling that doesn't signal a collapse, is becoming increasingly difficult to hit. We also have the Fed's March decision looms. The market will be looking for any hints in the dot plot or the chairman's press conference regarding the future of the balance sheet. Additionally, we are monitoring the results of the energy talks in Europe. Any concrete policy shift regarding energy prices will have an immediate impact on the inflation expectations for the Eurozone. To summarize, the global markets are in a state of recalibration. The Warsh era at the Federal Reserve has begun, and it marks a return to a more disciplined, hawkish monetary philosophy. This is strengthening the dollar, weighing on gold, and causing a repricing of risk in the US futures market. Europe is opening with caution, focused on an energy crisis that shows no signs of abating. The divergence between a hawkish Fed and a hesitant ECB is the primary driver of currency volatility. Oil prices remain elevated due to the geopolitical risk in the Middle East, while Bitcoin and the tech sector are struggling to maintain their momentum in the face of higher yields. My outlook for the next 24 to 48 hours: expect continued pressure on the Nasdaq and S&P 500 futures. The 6,800 level for the S&P 500 is a critical psychological and technical support. If it breaks, we could see a rapid move towards 6,750. In the currency markets, look for continued dollar strength. The Warsh Fed is not a market-friendly Fed in the short term. It is a sound money Fed. Keep a close eye on the energy headlines out of Europe. Any sign of a breakthrough in the von der Leyen-Birol talks could provide a brief relief rally for European equities. This is not a time for aggressive positioning. It is a time for capital preservation and tactical adjustments. The Friday jobs report is the ultimate arbiter of the next leg of this market. I am Sylvia Bizzoni. This was the Black Box Morning Report. Stay disciplined. Stay informed. Outro music increases in volume for 5 seconds, then fades out abruptly. AI out.